Back, everyone, and we're now ready to start Q&A. Joining me today are Eric Nordstrom, Pete Nordstrom, Anne Bramman, and Ken Warzel. Thank you for submitting your questions in advance. For the sell-side analysts, please feel free to continue to submit your questions throughout this session. We have about 30 minutes for questions, so we'd like to get through as many questions as possible. With that, I'm going to turn to our first question. This question is for Eric, coming from Oliver Chen with Cowen. Why is now the right time to look for new customers? What ages do you think are the biggest opportunity, and where are they spending now instead?
Well, a big drive has been the customer segmentation work we've done, where we have a deeper understanding of those customer segments that we perform really well with and where we don't have as much penetration. And as we discussed earlier, there's a segment in our Nordstrom business, and there's a segment in our Nordstrom Rack business of customers who are in our stores, who we get good feedback from, or untreated, because we're not carrying exactly the depth that they're looking for. And I think there's an external and an internal overlay to that. Externally, increasingly, customers shop everywhere, especially the best customers. They shop full price, they shop off price, they shop stores, they shop online. That's certainly true for us. When we get customers that shop cross-channel, their spend goes up 7x. When we have customers that engage in both of our brands, Nordstrom and Nordstrom Rack, their spend goes up 4x. That really lends to our model of the synergies in customer acquisition and migration. So Rack has always been a very strong customer acquisition vehicle for us, and we have really pinpointed areas where we can pour on the gas there. To the age, I want to say younger. It is younger, but part of that is millennials are aging. So our younger customers, the last several years, are getting into their sweet spot of spend, especially in our categories. But they have different expectations. And again, the millennials shop across everything more. So we see an opportunity to really focus on the millennials and grow our customer base there.
Great. Thanks, Eric. Next question goes to Anne, coming from Dana Telsey with Telsey Advisory Group. It wasn't too long ago that you achieved a 6% operating margin in 2018 in order of importance. What are the key drivers to getting back to 6%? And would you calibrate long-term as 3 or 5 years? Thank you.
Thanks, Dana. So I think what's really important for us is the fact that we are really focusing on driving profitable growth in the business. And so there is a commitment on delivering on the bottom line, but also growing the top line from a revenue perspective. And as you saw in the models shared with you in some illustrative examples, because of the way we've rebased our cost structure, we can actually achieve same levels of 2019 margin level on $1 billion less of revenue. And at the same revenue levels in 2019, we can actually get to that 6% plus. So we are really excited about how we're approaching the business and the rebound on this. So for us, it's about driving that profitable growth, gaining market share, and keeping the discipline that we have on our SG&A structure. As far as the question on 3 to 5 years, the way we're talking about it is 3 to 5 years. It's really a lot of unknown how quickly the marketplace comes back, given COVID vaccines and emerging market, people feeling more comfortable socializing with each other. But the way we're thinking about it is a 3 to 5 year time horizon.
Thanks, Anne. This next question is for Ken, and it's coming from Ed Yruma with Key Bank. How will you introduce new customers to Rack, particularly those that are more price sensitive? Does the focus on price-sensitive customers require new merchandising models?
Yeah, thanks, Ed. That's a great question. I'll start with the second part of the question. The focus on penetrating more and offering an offer that resonates more with those price-sensitive customers does have an implication for merchandise mix, and we're already moving forward with that. So lower price points in particular, they're price-oriented customers as opposed to brand-oriented customers, but also how we lay out the stores. We've already reset up a number of our stores to make navigation in those stores easier, which we know is something that, again, that set of customers responds to really well. In terms of attracting new customers to that, right now we're in the phase where we think we have a lot of opportunity to simply serve those customers who are already coming into the Rack store, fit into those segments and get a higher share of wallet. As we see the results of what we've already started to roll out, we'll then move forward with the efforts around what do we need to do with marketing and other mechanisms to expose that offer to even more of those customers.
Great, thank you, Ken. This next question goes to Eric, and it's coming from Omar Saad with Evercore. Digital is now 50%. Any signs digital profitability starting to inflect? Perhaps you could share anecdotes of how Nordstrom Digital Omni local market strategy drives higher and or more consistent profitability.
Yeah, we have seen. I think one of the points we really want to get across today is our fundamental model has changed. And we started that journey a couple years ago, really announcing our Investor Day in 2018 of market strategy. And market strategy is our business model today, and it has changed our economics, changed our cost structure. Specifically, we'll pull out one element of it, shared inventory. When we went to shared inventory, two things. For customers, we saw a 10% increase in spend. In our inventory, we saw over a 10% improvement in inventory turn. We've seen that in full price. Just launched shared inventory in our Rack business. And so far, the signs are it's actually tracking faster than what we saw when we launched it in our Nordstrom business.
Great, thank you, Eric. Next question goes to Pete, and it's coming from Adrienne Yih with Barclays. What are some of the high-growth digitally native business models, such as rental or resale, that can be incorporated into the JWN omnichannel model? Basically, how does Nordstrom evolve to take share in fast-growing new retail business models?
That's a great question, and hopefully what you've heard over the last couple hours is a clear answer to that, and that's really around our ability to have a platform that allows us to pursue different ways of extended models with different brand partners and different ways of serving customers things that they're interested in. But we can't do that if we don't have a platform that enables it to all work. And I think that's a big part of really our theme as we kind of look future back, is we need the agility that the digital technology efforts are going to afford us and have been affording us. And we're on that journey. So I think that's the biggest thing. And of those two examples, I think the resale one in particular is pretty compelling. We've done some of that. I think there's a way that we could learn from that clearly, and we can do it better. We're doing some of it right now too. So I'd say just stay tuned. That there's certainly an opportunity there, and I think if we're going to be meaningful to our customers, we're going to have to participate broadly in extended models like that, like resale.
Thanks, Pete. This next question goes to Ken, coming from Dana Telsey from Telsey Advisory Group. What does the store of the future look like for both Nordstrom Full Line and Rack, including size and what percentage for spring and what percentage for fulfillment options?
Thanks for the question, Dana. I guess my perfect answer is we're not entirely sure what the store of the future looks like, but what we do know is that we need the agility to change our formats and the way we use our physical assets to serve customers the way they want to be served. And you can see that in what we've done over the last 12 months, an acceleration of what we were already doing. So when you ask, for example, about order fulfillment and the role that those kind of services play in our stores, in both our Nordstrom full price stores and the Nordstrom Rack stores, if you go into it today, you'll see a fundamentally different presence for those services today and visibility for those things than you did even 12 months ago. And that just reflects the reality, which is that customers want to be served that way and expect us to be adaptable to do that. So what we have done is made all of our stores a lot more flexible with respect to their layouts and the ability to flex the space we have, whether that's across product categories or in this case, flexing into services. The other thing I just highlight is that we're going to continue and have continued to look at new ways to get connected and closer to customers. So for example, our Nordstrom Locals, which is our hyper-localized neighborhood hubs in LA and New York, we're really encouraged by those. COVID's an odd time, so it's a little hard to read all the signals. But what we know is that as all of our physical locations have been able to reopen, those locations in particular have rebounded even faster than the rest of our physical locations and are ahead of our projections and expectations with respect to customers engaging with that. So in terms of the size, I don't think we know enough to dramatically change our future plan. But in terms of the assets we already have, we have a lot. We have nearly 350 physical locations to supplement our digital capabilities. We're going to be agile in the way we use those, and we're going to continue to flex that in the way that customers want us to serve them better.
Thanks, Ken. Super helpful. Next question. The next question goes to Eric, also on stores, coming from Alexandra Walvis at Goldman Sachs. How has the pandemic altered your thinking on your store base and the size of footprint you need going forward to execute your local market strategy? How about the Rack store base? Is 300 still the long-term target?
Well, we made a pretty fast decision to close 16 Nordstrom stores early in the pandemic. All of our stores were profitable heading into the pandemic, but with the reset going on, and more importantly, taking a market view of our store base, that's been real helpful for us. The vast majority of those stores were small store in a multi-store market, and we look at our physical footprint as a portfolio by market, and that portfolio is Nordstrom stores, Nordstrom Rack stores, local service hubs. And we really like that portfolio and the flexibility that it gives us. And I guess to Ken's comment, we don't know exactly how that'll play out, but we really like the flexibility and the synergy of those locations. We anticipate big Nordstrom store closures moving forward. We have a tighter store count than most of our traditional mall-based competitors. The Rack stores, we believe there very well could be new store growth opportunities there. Rack stores have a short lead time to make those decisions and build them out. And it's as we expand the aperture of who we serve, particularly with price, we think there is an opportunity for potential store growth there.
Thank you, Eric. This next question is for Pete, coming from Michael Binetti with Credit Suisse. The new inventory model seems like it would shift some of the inventory and working capital risk back to the brands. How are your brands thinking about taking on that incremental risk, and how are they asking to be compensated for it?
Well, I think it starts with understanding the size of the prize in terms of how big the business can be. And if we're more transparent with each other, we could arrive at a solution that's mutually beneficial. I don't think, it goes somewhat to what we were talking about in our panel. And we got to move away from a transactional way of doing this and more of a collaborative way. And again, it's been our experience really highlighted through this last year that the brands want to work with us to find different ways how we can serve customers better and improve speed and agility and in a lot of ways share the risk. I think that's been a pretty consistent theme. So that continues to evolve and it gets enabled really on our end, I think, through trust. We've got a great team of merchants that have been doing this for a long time, have great relationships in the market. When you can build that trust and you can be more transparent and you can find win-win scenarios. So I don't think the idea is how we're offloading risk onto the brand partners. I think we're just trying to find ways to share that risk in a way that enables the business to happen with greater speed and agility and it's more relevance for customers.
Great. Thank you, Pete. This next question is for Ann and Ken, and it's coming from Chuck Graham with Gordon Haskett. As you expand the range of price points at the rack, will this have a material impact on the merchandise margin structure of that segment? As a follow-up, how big of an opportunity does this represent from a customer acquisition standpoint? So Ken, if you want to take the customer question, and then Ann can follow on with the impact on margins.
Yeah, I mean, as we showed a little bit and talked about, and you heard Gibi talk about, we think the opportunity is significant. We're significantly underpenetrated with that price customer relative to the opportunity. And we think there's, if you just look at our ability to serve that customer, but where we are as a starting point, certainly growing that by 50% seems imminently doable as we adjust the merchandise mix and the merchandise model to be more relevant for that customer. So we do think it's a huge opportunity. And the one thing I just add to that is when we are able to engage that customer, they look very similar in terms of the rest of their behaviors, in terms of engagement with our overall brand and our overall company. So we still see a third of those customers, even if they get acquired as price customers, they become Nordstrom full customers over time. They're similar in terms of their multi-channel shopping behavior over time. And so that means their spend and customer lifetime value goes up. And to get there, yeah, we do have to adjust the product mix, but we're also adjusting other aspects of the offer in terms of category as well, as we talked about some of the traffic driving categories in our both of our brands, but in Nordstrom Rack in particular, between beauty and home and active and kids. So we think we drive more trips if we have the offer that's relevant there. So even with a lower ASP and some of that, we still think we can get similar productivity and frankly, even better economics in many cases. And I'll let Ann add on in terms of the margin implications.
Yeah, Ken, you said it well. When we look at this business, we see it's a great opportunity on the margin side as well. It's a high turning, it's traffic driving, it's engagement, it's trip driving. So we see this as really helping continue the strong profitability of our Rack business.
Thank you, Ann. This next question is for Pete, coming from Paul Lejuez with Citi. How do your existing brand partners factor into taking choice count from 300,000 to 1.5 million? How much of that increase is driven by doing more with existing brand partners versus bringing on new brand partners?
Well, I think the first opportunity has to do with offering more from the favorite brands of our customers. You know, when you're bound by the physical limitations of a store and the physical footprint, it doesn't allow you to carry the full assortment. So, I mean, just looking like in our top 50 brands, you know, being able to let customers know that if you love these brands, we've got everything they have to offer. We don't have to artificially limit it based on the physical footprint. And that's the beauty of the digital first mindset. And so that's really how we're looking, I think, initially is let's give them the stuff that we know they already love, the brands already love, extend that selection, work with our brand partners to be able to do that. Oftentimes that comes through drop ship. And then I think, you know, ultimately, again, as the platform enables us to do this and we can do more of that work around just, you know, the functionality of dealing with all those choices and everything that goes with that, as we can leverage our technology, our data, and our platform to be able to enable that, I think that's going to be a big unlock for us as well.
Thanks, Pete. This next question goes to Ann, coming from Brian Callen with Bank of America. It's a multi-part question, so I might just summarize it slightly. Can you provide perspective on cash generation dynamics in 21, including working capital sources or uses and CapEx? And then more broadly, can you talk about how you're thinking about capital allocation as it relates to debt maturity and investment grade credit ratings?
Yeah, thanks for the question. And you know, we've talked about this both today as well as in the last several quarters. Our capital allocation philosophy has not changed since prior to COVID. So first and foremost, we're going to invest in the business, and we're targeting about 3 to 4% of revenue being reinvested back in the business. And the majority of that is going to be in continuing to develop our capabilities in our platform, both on our supply chain side and our technology side. So that is a significant portion of where the reinvestment's going. The second piece to it is investment grade. And we had set out targets, leverage ratios prior to COVID hitting, getting to 1.5 to 2.5 times. And as we talked about for 2021, we are expecting to get to around the 3 times mark by the end of the year for fiscal 21, with the goal and the target to get back in that range pre-COVID by the end of 22. So from a cash perspective, we've already been generating positive cash flow since after Q2, and we are continuing to build that operating cash flexibility and that strength. So one of the targets we've given, the commitments we've made, is to have at least $1 billion plus operating cash each year, which is what we've did prior to COVID. So as we get through the next time period where we're starting to build the business back, that is the commitment to get back to.
Thanks, Ann. Super helpful. This next question goes to Ken, coming from Kimberly Greenberger with Morgan Stanley. You indicated you expect margin parity between Rack and NordstromRack.com over the next several years. What are the key levers to get the business there?
Yeah, it's a great question, and there's a few. I mean, we talked about them sort of separately, but to bring them together, one is what we're doing, we've already achieved in terms of bringing together the inventory. So shared inventory provides a lot of benefit for us in terms of the business, but one of the economic benefits it has for our digital business is we get access to a lot more inventory for our customers without having to make more investment and take on the markdown risk associated with that. And we know from our full price experience, as Eric referenced, Pete referenced, that we get both top line benefit from that, but we also get margin benefit by avoiding markdowns. So that's part of the way we get there. We also get there by getting the scale economies that come from really leveraging our platform and the capabilities we've already build it once and then use it many times. And what we're doing there, as we talked about, is we're currently in the process of moving our NordstromRack.com business onto the same JWN e-commerce business that supports Nordstrom.com. And frankly, the pilot we had for that was our launch of Nordstrom.ca. So we have already seen the leverage we can get by bringing a second and now a third digital part of our business onto the same platform. And there's an economic advantage to that because we're reusing technology we've already built and getting leverage off of it. And the third piece is we continue to have opportunities and are seeing real gains in the fulfillment side of the equation. And you're going to see us continue to make progress there as well. As we've built out our fulfillment network, we're also building out the capability for all of our fulfillment nodes to serve both of our brands. And that brings scale and cost advantages as well to the whole business, particularly important for our NordstromRack.com business. So we have a lot of levers that are already in motion, and we've already seen the benefits of it. So we're confident on the path we're on there to get to comparable economics across channels.
Thanks. This next question goes to Ann, coming from Jay Sole with UBS. Would it be possible to elaborate on what fiscal year 21 EBIT is expected to be positive means? In other words, should I assume that means around 0 to 50 million in EBIT or something larger?
Yeah, thanks for the question. We are really looking forward to spending more time on our 2021 plans on our earnings call on March 2nd. Having said that, what I can say is that we are committed to driving profitable growth as we gain market share. And that's something that you see from all of us making that commitment and that focus. The other thing is you've seen some of our target for our leverage ratios as well. So getting down to 3 times, I think would imply something beyond a $0 EBIT.
Thanks, Ann. This next question goes to Pete from Omar Saad with Evercore. How easy is it to integrate concession and drop ship while maintaining the customer experience? Adding third parties can make it tricky.
Yeah, it can, but I think it gets back to those win-win scenarios. And as I think, again, was illustrated in the panel, these people we do business with, they're also retailers as well. So it's not as though these concepts are foreign to them. I think they know how to deliver to customers, and it just kind of gets back to that trust. So I think we lose some control, but the confidence that we have with the trusted brand partners, I think, enables us to work. I want to give you a good example of that. So, we've been doing Topshop business for several years. It's been super successful for us. And that arrangement wasn't exactly a wholesale model, wasn't exactly a concession model. It was kind of a hybrid, and it evolved over time to work out the best interests of the business. And that flexibility existed for us because we had a good relationship with those guys. And now you see where Topshop has been sold to ASOS. And I got to tell you, it's super exciting for us. I mean, ASOS is really good at what they do. They really understand that young fashion customer. They come from a total digital first mindset and how that platform works. And, so the journey begins as we're working with them to figure out how we can grow our business. And it's going to come through the transparency of understanding how the business works and what the opportunity is as we listen to each other. And I have no doubt that the model will evolve from what we have now because it needs to, and it should. And just have a better view, I think, collectively about what needs to happen to grow that business and how speed's a really important part of that. So I think it's illustrative of when we have these relationships, kind of where it's taking us. And again, we are super enthusiastic and optimistic about what can happen with that Topshop business with ASOS.
Very exciting. Thank you, Pete. This next question goes to Anne, coming from Chuck Brown with Gordon Haskett. Can you give some insights on inventory efficiency opportunities in the model and what turn ratios you are aspiring to?
So as we continue to evolve the model, we certainly expect the returns, the inventory turns to improve. And it's certainly it's a less asset intensive piece to the working capital. I think where you're seeing this come out is on the return on invested capital. And if we go through this model and we laid out the scenarios for you, both on what it would take to deliver the low double digit to a low teens ROIC, it really would imply there's a flex point between that investment and the returns and the margin coming out of that. The good news is we can get back to exceeding our cost of capital as well as having a good return for our shareholders over the long term, which we think ROIC is the best measure of with these different levers that we can pull in the business.
Thanks, Anne. This next question goes to Eric, coming from Edward Yruma with KeyBank. Can you provide more color on opening the aperture on rack price points? Is there a risk of damaging the premium positioning of the Nordstrom brand?
Well, first, I think it's important to understand these customers are in our stores already. We know we have customers in our rack stores that not only shop us, but shop at these lower price points as well. And they go to other retailers to get these lower price points. We haven't seen any evidence that as we expand price points, that there's really anything negative to it. As you go back a few years where we had a lot of growth out of our rack business driven by store openings, that was something that we monitored very closely of a lot of customer surveying and brand impressions and as the growth of our rack business, how did it affect the Nordstrom brand? And not only did we not see anything negative, it actually came back as a positive. Again, as I emphasize, customers are already shopping this way. They shop across price points, and they look for us for some things. They look for us and view us as advantaged in bringing newness, in the discovery of brands they haven't and styles they haven't tried before, of quality. And so that discovery piece is a big part of it. And the other piece people look to us is a service leadership. And that's been, I think, a strength of ours in stores. And what we've tried to get across here today is our focus in translating that service reputation to the world. So we think there's a lot of space there in price of product to maintain our strong reputation. And I think the other piece to that, those strengths that our brand has is we have a strong brand. We've been around a long time. Customers think of us, and we're fortunate in the reputation our brand has been developed over many years by our team, allows us to expand our customer base while still maintaining the strengths of quality service and product that they expect.
Thanks, Eric. Super helpful. This next question goes to Ken, coming from Dylan Carden with William Blair. Has there been a disruption in the business as you've implemented some of these new initiatives?
There's not been a disruption in the business. I think that these initiatives actually, if anything, while there's been a lot of challenges in the last year with store closures and all of the other things that have come along with COVID and the impact of that, it's also given us an opportunity to move fast on a number of things. Just to go back to the example we've referenced, the integration of inventory on the rack side and enabling our stores to fulfill out of those stores as well as to do order pickup and returns for both brands out of our rack stores is an example of something that we got done this year on an accelerated timetable. It would have happened sometime later, and it probably would have happened 6 to 12 months later if it wasn't for the urgency we're able to create, but also the opportunity we're able to create around focus on that. And that was because we knew that that's what customers wanted and needed in the period, and it was also important for the business so that we could use our stores even if sometimes they weren't open to retail traffic. So it's required agility from the business and our teams. It's required reprioritization, but I don't think that's disrupted the business. I actually think it's accelerated the change journey we've been on to get even faster and to leverage technology in a more scalable way to get us to those outcomes for customers faster. So it's definitely been a challenging year for all the reasons that folks know. So in that sense, it's been disruptive. It's as a retailer that has physical locations as well as digital, it's super disruptive when those locations can't be open to serve customers. But at the same time, it's given us an opportunity to really take advantage of the multifaceted capabilities we have.
Thank you, Ken. This will be our last question, and it's for Ann, coming from Kimberly Greenberger with Morgan Stanley. So are the SG&A savings from the store closures earlier this year included in the $200 to $250 million of planned savings? So I think this goes back to 2020, but if you can also give some color on how you're thinking about expenses going forward.
Yeah, so we set a target beginning of the year prior to COVID for expense savings, to find expense savings in the business. And then as COVID hit, and you heard from a lot of us today that we made pivots and changes and accelerated some of the strategies that we had in place. And as part of that was looking at really rebasing our entire cost structure, focusing on knowing that the digital piece of the business was going to be at least, it's going to be about 50%. And also knowing that our rack business was going to continue to be a big growth driver for us as well. And so when we looked at the rebasing of it, there was a piece in the SG&A savings that relates to the store closures, but that's not the biggest driver of this. It's really across the board in many different areas as we looked at redoing our cost structure. So fast forward to 21, about 75% of those savings are permanent, and they're just a permanent part of how we're doing business and getting more scale out of the investments we're making. And we're going to continue to get more scale out of the investments we're making based on everything you've heard today, in particular with our technology capabilities and platforms.
Thank you, Ann. So this concludes our Q&A session. Thank you so much for your time and your questions. If there isn't anything or any follow-up, please feel free to reach out to me or Investor Relations team. As a reminder, this webcast, along with the presentation, will be available on our Investor Relations website. So with that, I'm going to turn it over to Pete for some closing remarks.
Thank you, Trina. We really appreciate this opportunity to address you today and share our optimism and enthusiasm for the future. We hope that came through clearly. A lot of work has gone into this, and it's really a culmination of multiple years' work in this journey that we've been on. That's been really accelerated through the challenges of our recent times. And while that's been challenging, obviously, it's presented just an enormous opportunity. I think it's through that filter that we approach this, and it's given us a chance to look at the business future back And so it's why you're hearing optimism from us. You know, I'd be remiss if I didn't take the opportunity to thank some people here first. I mean, first of all, thank you to the people that are watching this event today. Thanks for your attention and engagement. I want to thank the production team. I'm sure everyone can appreciate that in these moments when we're doing all these things virtually, and it's different than perhaps we've done stuff in the past. And they've done a really nice job working hard to make this hopefully painless for all involved. Certainly on our end, it's been really good. I want to thank probably primarily before I do that, I want to thank the guests that appeared today, like in the panels and what have you. It's great to be able to get those kind of voices in to help lend some context to what it is that we're talking about and some proof points and how we work together. So we really appreciate that. But lastly, I want to thank our employee group. We talk about a challenging year. I mean, we've asked everyone that worked here to think about how to do it differently and to really grind it out, you know, with the overlay of things that are literally existential threats, and also thinking about how we can maintain and keep that connection with customers, which is so important for us. And our people have shown a resilience and agility, a determination with you know, kind of a change mindset, and it's enabling us in so many ways to be able to go forward and be successful. They've just done an amazing job. You know, I know we say it all the time, but people are such a huge differentiator for us, and what it really means for the brand impression and obviously the results what we deliver. The last thing I want to talk about is kind of elevate a little bit from all the tactics that we've kind of explained in detail today, and that's to say, well, why are we doing all this? And I'm reminded as I was riding in the elevator today of reading this quote that's on the wall from my dad. And I see this stuff all the time, but for one reason I seem to notice it more today. But it talks something about, I'm paraphrasing, that our reputation is 100% built on the trust and confidence of customers. And make no mistake about it, customer service is our single biggest differentiator. So when you think about all these things that we're doing, you know, they can be complicated, they can be academic in nature, but to be clear, the reason that we're doing them is to make customers feel good and look their best. And we know that we make customers happy, that the sales follow and the results follow. We've got a long history of working that way, and it's afforded us a wonderful opportunity. We have generations of customers that trust Nordstrom. And when things change or evolve and they look to how they want to spend and who they want to engage with, what companies reflect their values and what companies do they value, you know, Nordstrom should come at the top of that list. That is our guiding principle, and the more we stay focused on that, the better off we are. I want to make sure everyone understands that that commitment is as strong today as it's been, and it is going to be what's going to bring us the kind of results that we're all planning to have. So thanks again for everyone for being a part of this. Have a great day.